Thanks for including this paper in this very nice conference. So the paper's title is What You Do and What You Do Not Get When Expanding the Net Evidence from Forced Taxpayer Registrations in South Africa. And the broader question behind that paper is how effective are formalization programs, especially in less developed countries. And if you look at the evidence on that question in the existing literature, then the picture is actually rather bleak. So what we know is that providing information, reducing registration costs, or simplifying regulation actually hardly raises formalization rates. So there are some measures that have been found to be effective. So for example, visits by tax inspectors or large incentive payments, but these interventions are rather costly and it's not really clear whether you can scale them up to the economy at large. So in these prior papers, they have been assessed in very small scale field experiments. So where our paper starts is that tax authority digitization, and we heard in Rebo's talk a lot about that, may help improve the ability of the tax authority to actually to bring taxpayers into the tax net. So in a broader sense, tax authority digitization, of course, allows for many new enforcement strategies, and many see it as a very powerful tool to shift light on the shadow economy. And in particular, the tax authority is put in the position to actually compare its registries to potentially other registries that are available in the government sphere. And what we do in this paper is we compare or we assess two interventions that were run in South Africa, where the South African Revenue Service compared its business tax registry to the commercial registry and basically identified many firms that actually by law had to sign up for business tax purposes and hadn't done so. And these firms were drawn into the tax net. And what we do in this paper is basically to see how many firms were drawn in and what was the revenue impact of these interventions. And these interventions were done twice, so first in 2008 and then in 2014, and they were snapshot synchronizations. So today in South Africa, these registries are fully synchronized, but they hadn't been at that time. And the analysis relies on very rich data. So we have information on the tax registry and on tax returns and tax payments of these firms. So what we do in the paper is we first look at the direct effect. So the question is how many firms were drawn in, and from these firms that were drawn into the tax net, how much taxes did they pay? And if you think about these tax payments in the aggregate, then of course these tax payments depend on the number of firms that were drawn in, but also on the revenue collected per taxpayer. And how much revenue is collected per taxpayer very much depends on the behavior of these firms after registration. So essentially, were they compliant? So did they submit a tax return? How much taxable income did they report? And conditional on having a positive tax liability, did they pay the tax due? And if you think about a firm that was drawn in that wouldn't have registered with the South African Revenue Authority voluntarily at a later point in time, then the additional revenue collected by that firm can be depicted here by this delta tau I. And this is essentially over all periods in which the firm is active, the product of the tax rate that is applicable to that firm, a dummy variable, whether the firm actually submits a tax return, then the taxable income that is reported to the authority, and then a variable that captures tax payment compliance conditional on having a positive tax liability. And what you see here, and that is probably, this is much more aware to practitioners than to academics, I guess, is to say tax compliance is really a multi-stage process. And for the tax authority to collect any revenue, the firm actually needs to comply on each and every stage. Yeah? And so if you think about these registration interventions, they are enforcement interventions on the first compliance stage, and to collect revenue, these firms need to comply on all these post-registration stages. And if you now think about less developed economy context, then of course there are question marks because the economic environment is not so strong. So these firms may just not be profitable and for that reason not pay any taxes. And the enforcement environment is in a sense limited. And so, so you may a priori have some questions on whether these measures can be successful. And another important dimension is, of course, taxpayer selection, because if you think about firms that fail to sign up for tax purposes, they are not a random subpopulation of all firms in the economy. Yeah, so there may be a wedge between the behavior and characteristics from the post-registration perspective between forcibly and voluntarily registered firms. And it's not clear from an a priori perspective in which direction these selection effects go. So if you think about a post-registration compliance behavior, it may well be that you actually have a positive correlation of compliance behavior across stages. So it could be that firms that fail to sign up for tax purposes and are drawn into the tax net also show suboptimal or below average compliance behavior on later stages. And that would be the notion that there are some non-compliant types and they just behave non-compliantly on each and every stage. But the inverse could also be true. So it could be that firms for some reason anticipate that they will be compliant after registration, for example, because they anticipate to be subject to very tight scrutiny of the tax authority after registration. And then they actually have an incentive not to sign up for tax purposes, just to stay off the tax authority's radar. And if they are caught and brought into the tax net, it could also be the case that they actually show above average compliance behavior. So from a theoretical perspective, it's not clear how they behave. And the same is true for taxpayer selection and firm size. So it could be that it's the small firms that fail to sign up for tax purposes, because we know that their probability to be targeted for that non-compliance is smaller. And if they behave accordingly, they have a higher propensity not to sign up for tax purposes. But if you think about large firms, then their incentive, of course, is higher not to sign up in first place, because they gain more from not being visible to the tax authority. So it could also be, in principle, the case that it's actually the large firms that stay off the tax authority's radar. So again, and also in firm size, the effect is ambiguous. So we bring all these questions to the data, and our testing ground, as I already said, is South Africa, and in particular, business tax enforcement in South Africa. And business taxes are levied in South Africa on incorporated firms at a proportional company tax rate of 28%. And only small business corporations are actually subject to lower rates. And to incorporate in South Africa, you need to sign up with the so-called CIPC registry. That's the Companies and Intellectual Property Commission. So that's the commercial registry of the country. And there are several benefits, of course, from incorporation, so mainly limited liability of owners. There is arguably facilitated access to external capital, and there are more opportunities for transactions with other formal businesses. And what we know from prior evidence is that incorporated firms have a number of good characteristics. So they show above average productivity and they are larger than other firms. So what we would expect from an ex-ante perspective is that they are actually fiscally very valuable. Yeah, so very valuable subset within the shadow economy, so to speak. So in terms of formal tax obligations at the time period that we look at, so firms that registered with CIPC were obliged to register with SARS for business tax purposes within 21 days, irrespective of size and taxable income. And then they must submit tax returns for every tax year in which they were active. And enforcement is done through audit and fines on all compliance stages. So the interventions that we look at were two snapshot synchronizations of the business tax registry and the commercial registry that were conducted in April 2008 and February 2014. And all the identified non-compliers that were in the commercial registry but not in the tax registry, they were actually drawn into the tax registry. And here is a first notion on how many firms were drawn in. So that is our sample period starting in early 2007 and ending in late 2014. And this is the number of tax registrations with the business tax registry per month. And you see these big spikes here. Yeah? So in April 2008 and then again in February 2014. And these spikes are related to the registry comparisons when they drew a large number of firms in. So at both points in time, around 300,000 firms were identified and drawn into the business tax registry. And that's a massive expansion of the business tax net. So that was 11% in 2008 and 8% in 2014. So these interventions were very successful in bringing taxpayers into the tax net and arguably at very low cost. Okay, so if you think about the success dimension, so they brought these taxpayers in, then there are two stories. So either they brought taxpayers in that would have never signed up for business tax purposes voluntarily, or they brought taxpayers in that would have voluntarily registered at a later point in time for business tax purposes. And what we try to do in our study is to quantify one and the other. And what we do is we calculate from our data the propensity to register with the tax authority for business tax purposes as a function of the time that has passed since your CIPC registration. And what we see is that the more time passes from the CIPC registration, the lower the propensity to sign up. Yeah, and this propensity actually steeply drops. That means if the firms are quite old in terms of CIPC registration, their propensity to voluntarily sign up for business tax purposes is actually very small. And that means for our purposes that firms that were young at the time of the intervention, they actually may have a quite substantial propensity to have signed up voluntarily at a later point in time. But if they were already old, then this propensity is very small. And what we do then is that we basically determine or get an estimate of the cumulative number of firms that would have voluntarily signed up in the absence of the intervention. So this is a graph for the 2008 intervention here. These are just the tax years, and these are this is the time here, and these are the number of firms that were drawn into the tax net, around 300,000 in 2008. And this is the cumulative number of firms that would have signed up voluntarily at a later point in time. And you see that this is a small fraction. So we estimate it at around 17 to 20%. Yeah? So most of these taxpayers that were drawn into the tax net would have never voluntarily arrived at SARS and signed up with SARS. So the next question that we then ask is, what were the revenue effects? So these taxpayers that were drawn into the tax net, how compliant were they afterwards? How much revenue did the authority collect from them? And if you focus on the graph on the left-hand side, so that is the data for the 2008 registry comparison. So they drew around 300,000 firms in. And what you see is that only around 15% of these firms actually submitted a tax return at least once. So that is a rather small fraction. And what you see is that even a smaller fraction actually has a positive tax payable at least once within our data frame. So this is important too. So our data frame ends in 2014. And then only 2% actually really make positive tax payments of these firms that were drawn in. And you see a very similar picture for the 2014 registry comparison. And then we asked the question in the next step, so can we make a statement about the compliance behavior of these firms that were forcibly drawn into the tax net relative to comparable firms that voluntarily signed up with SARS for business tax purposes? And we first here in panel A look at the propensity to submit a tax return in an active year. So we're restricting the data already to years where the firm is deemed active according to the registry. And the dark gray bars give the propensity to submit a tax return for firms that were forcibly registered in 2008 and 2014. And the light gray bars are the control firms that voluntarily signed up for business tax purposes and are broadly comparable to these forcibly registered entities. And you see that there's a big gap in the propensity to submit a tax return. So they are significantly less compliant. And here in panel B, we look at the propensity to, conditional on submitting a tax return, to have a positive tax liability. And again, you see that the propensity, the dark bar is for the falsely registered and the light bar for the voluntarily registered. You see that the propensity to have a positive tax liability is much smaller for these firms. And here in panel C, you see the same for tax payments. So conditional on having a positive tax liability, what is their propensity to actually pay the tax due? And here again, the dark gray bar is for the falsely registered, the light gray for the voluntarily registered, and you see this gap here. And in panel D, you see the same type of gap for the propensity to submit a tax return on time. Yeah, so again, there's a gap in the compliance behavior of these entities. So these falsely registered entities, they behave less compliantly in post-registration stages, which means that the compliance behavior correlates positively across stages. Then we look at the same or a related issue and ask the question, if we look at the actual tax liabilities of these falsely registered firms and their tax returns conditional on submitting a tax return, and we compare it to the tax liabilities of the voluntarily registered firms, we see a big gap. So this is an 80% gap. So here for the 2008 registry comparison, and here for the 2014 registry comparison. And in the paper, we actually show that this gap to a significant extent relates to the fact that these falsely registered firms are actually much smaller in size. So this is not only compliance differences, it's also size differences between these firms. So it's the small entities that select into non-registration and were then drawn into the tax net. Okay. So then from a tax revenue authority's perspective, of course, it's very important to understand the aggregate effect. So they did this intervention, they drew all these firms in. So how much did they get out in the aggregate? And what you see here, so this red line marks the overall number of tax returns that were submitted by taxpayers that were falsely registered in the 2008 registry comparison. And you see that in total, more than 150,000 additional business tax returns were submitted. Our estimates, however, suggest, and this is the dashed line here, is that many of these returns would have also been submitted in the absence of the intervention. But still, this is like a massive number of additional tax returns that are received. But still, you need to keep in mind that only a few of these tax returns actually resulted in tax payments. Yeah, so many of these tax returns actually, so the large majority did not report any positive tax liability and then resulted in tax payments. So this is here actually on the right-hand side given by the green graph. So this is the number of positive payment returns submitted. And the dashed line is again the returns that would have been submitted in the absence of the intervention. And we estimate that around 3,500 additional positive payment returns were submitted because of the intervention. And this nevertheless translates into a quite substantial additional revenue collection above 22 million US dollars. So in the aggregate, from our perspective and our estimates, this was definitely a cost-effective intervention. Okay. So these were the direct effects. And if you think about the impact, however, it's important to acknowledge that there are also indirect effects. So the South African Revenue Authority ran this intervention, and they may not only collect additional revenue from the targeted taxpayers, but also from non-targeted taxpayers through potentially deterrence effects. Yeah. So if you think about the effect on non-targeted taxpayers, it may be positive because taxpayers may anticipate that the enforcement capacity of the authority increased and then may behave more compliantly. But in theory, it could actually also be that the reverse effect holds true, because of course there may be some kind of congestion effect at the level of the tax authority, because if you draw so many taxpayers in, they need to be administered, and perhaps the propensity of each taxpayer to be targeted by the tax authority goes down. If they anticipate that, then compliance behavior could potentially also drop. And with these interventions, there was like no broad scale communication by the authority, but our presumption was that taxpayers might actually tell other taxpayers in their network when they were targeted by the revenue authority with that intervention. And so what we did is that we looked at areas within South Africa and actually determined like strongly treated areas where many firms were drawn into the tax net within that intervention, and compare registry compliance, registration compliance of new firms in these areas to weakly treated areas where not so many firms were drawn into the tax net. And here you see the difference in compliance rates between these weakly and strongly treated areas and how they change at the time of the intervention. So here the dashed line is the time of the intervention, and you see that the registration compliance in the strongly treated areas relative to the weakly treated areas actually massively increases. So this is a strong increase in compliance behavior. So in relative terms, that's the propensity to submit, to register the SARS on time increases by something like 50%. So this is also in quantitative terms a really big effect. And what we show in the paper is that this effect, to some extent or to a large extent, relates to timing responses. So taxpayers that would have registered anyway register now on time, but to some extent it also relates to an increase in the number of tax registered firms, so that more firms sign up. And what we also find, and that's the last bullet here, is that we see like a drop in the number of firm registrations on the commercial registry, but this drop is very small. So it's statistically significant, but it's small. Yeah. So, and you may anticipate that if the firms anticipate that when they sign up with the commercial registry, automatically, in a sense, also sign up with the tax registry, that the incentive to sign up with the commercial registry may go down. And we see that, but not to a large extent. So to wrap up, we showed that synchronizing the business tax and the commercial registry can draw many firms into the tax net. And what was quite astonishing to us is that although these firms are arguably a quite fiscally valuable subset within the set of unregistered firms, the compliance behavior is rather weak, and so it's cost effective, the intervention, but we see a lot of non-compliance after the registration. And we see some evidence for deterrence effects, so that there are indirect effects that go beyond the targeted taxpayers. Many thanks for listening.
Thank you, Nadine, for a really wonderful talk about this paper. I really enjoyed reading it, and I thought it was a really interesting intervention, and it was a really interesting approach to how you sort of looked at these, and I really liked it a lot. So just to give a quick summary, basically there's an intervention where South Africa matched businesses from their company's intellectual property commission to their revenue service in 2008 and 2014, and any firm that they didn't match, they automatically registered with the tax authority, and they notified them by sending them a letter, and that's really the only cost of this registration program. And so some of the main effects were that both the 2008 and 2014 registrations resulted in an additional roughly 300,000 taxpayers, and only about 20% would have ultimately registered absent this sort of forced registration. Unfortunately, or maybe what to be expected, only about 12% of newly registered ever file at all, with only about 2% paying non-zero income tax. So it's not like this really large expansion in the tax net really brought in all that much revenue. And as I mentioned, even though it didn't bring in a whole lot of revenue, intervention is ultimately a net positive due to really low program costs here. But revenue gains are fairly limited, as it's only roughly 22 million US dollars over a 6-year period. And so I just want to highlight the direct contribution that this paper makes. So it really shows quite dramatically that tax registration is not going to be a sufficient condition for collection and compliance. So just sort of almost forcing people into the formal sector isn't going to make them tax compliant in and of itself, and more work needs to be done to bring these firms into to really get them to be compliant with their taxes. Additionally, forced registration improves compliance of new firms, and this is sort of consistent with the broad literature of sort of the network effects of taxation, such as Traxler, who looks at sort of TV tax. If you send a lot of inspectors into one area, then that sort of spills over into other households. And finally, the paper really highlights the limits of information on tax compliance, and specifically a lower capacity environment. And I just thought that was really fascinating. And so a few things that I really liked about this paper, I thought that it was a paper that was told in figures, and I think that's really important, and is very clear visually, sort of everything that was happening with the policy and what the results were. And in particular, I personally really liked sort of your counterfactual analysis, showing on the impact of the forced registrations on the entire tax system, from returns to non-zero returns to tax payments. I just thought that was super informative, and it was very clear sort of the magnitudes and size of these. Additionally, I really like the spillover analysis. I think knowing that the intervention led to higher future tax registrations is a really important consequence of this policy. I guess I must have missed it in the paper. I didn't necessarily see some of the other outcomes that you mentioned at the very end. But maybe if there were, if there a way to maybe tie those to those, as I said, that might help inform that a little bit. in terms of any revenue effects. And so just a few questions and comments I have. You mentioned this briefly, but I think a more thorough discussion of spillovers in other tax revenue sources might be helpful. You mentioned maybe modest revenue impacts on VATs because you see higher VAT registrations. But to me, the sign of this really isn't entirely clear if it's whether it be negative or positive, as maybe those who register to the VAT are those more likely to make more claims on inputs. So it's not entirely clear to me. It also seems plausible that if firms were previously reporting on personal income tax returns their business income, they could feel less obligated to do so now that they are registered with the business tax system. But I don't have clear evidence of that. Just a thought. Second, while I think the intervention is revenue generating, it might be more beneficial just to highlight some of the efficiency costs, right? So there's going to be you're adding a compliance cost to individuals who basically are zero filers, so they're not reporting any income. Maybe that's truthfully, maybe it's not, but that's still a cost on those taxpayers. Second, you see that decrease in the registration of firms for the business registry, and that might be really be a really strong, that might be negatively affect their welfare significantly, and that does seem to be a sort of a cost of this policy. And I just think maybe a bit more discussion about efficiency would be helpful here. And then finally, I think you mentioned that the firms expect enforcement actions and sort of your theoretical model, but as you've sort of alluded to what extent are these newly registered firms subject to enforcement actions? I'm not sure, and my guess is it's probably pretty limited. But besides that, like I said, I really enjoyed the paper, and I appreciate having the opportunity to talk about it here.